Short selling is a concept that can be confusing to a lot of investors. So if you feel a little uncertain as we go through this description, hang tight because we're going to do a case example that I think will make it much more clear. Short selling is basically opening a position by selling it first, assuming that in the future you're going to be able to buy it back for a cheaper price. Now, how do you do that? Well, when we sell to open and buy to close, you're basically borrowing the stock from somebody else. And in reality, you're borrowing it from your broker, basically. So you sell to open by borrowing the stock, and you don't need to worry about that. It's just an order type. Sell to open is the order type for selling short on a particular stock or ETF. Now, buying to close is just unwinding that position, or basically buying the stock or the ETF back later, and hopefully at a cheaper price, so you get to keep the difference and then pay that back to your broker. Now, margin and interest is going to be required and incurred in a short trade. And what I mean by that is that you have to have a margin account in order to engage in short selling. If you don't know what that is, spend some time talking to your broker, find out whether or not you're qualified to use margin and whether it's something that you're interested in. And assuming that you are qualified for margin, short selling does incur some interest charges because remember, you're borrowing stock from your broker, so they're going to charge you for that.